Hi friends, a lot of people actually keep asking, whether is it beneficial to invest through mutual funds or is it beneficial to do direct investing in stocks? So in this specific video, my friend, I'm going to share with you some of the key benefits and advantages of investing in mutual fund. And also we're going to see some of the disadvantages of investing in mutual funds. So we're going to understand mutual fund sahi hai ki nahi in this specific video. So please watch from the start till the end so that you can understand all the 7 advantages and also 4 disadvantages of investing in mutual fund, and then take your call. Take your own judicious call for yourself whether you want to take the route of mutual fund or direct investing. So please share it to your friends, relatives, colleagues, so they can also get an understanding of what are the advantages and the disadvantages of investing in mutual fund and take a decision for themselves. So let us see first the advantages. What are the 7 advantages of investing in mutual fund, and then subsequently we're going to see the 4 disadvantages. So advantages, when it comes to advantages, the first advantage, the first key advantage that an investor gets by investing in mutual fund is that he gets access to a professional management. He gets access to this professional fund manager who has the experience, ability and capability as well as the time obviously available to him to go through this plethora of companies, which are listed in the stock exchange, understand all the financial research, do thorough in-depth analysis about the company, and then decide whether to invest the particular investor's capital into the specific company or not. So all this otherwise an individual investor would have to do for himself, going through this plethora of companies and then also investigating the financial statement, the financial positions of the particular company, and also understanding future prospect, the management capabilities. All these aspects an individual investor may not have the time, neither the interest, neither the ability to do so because of his current work situation or whatever situation that working professional might actually be in. So that's the first key advantage. The second key advantage which you get is your liquidity benefit. Because of a large number of investors actually putting their money into the mutual fund, you get a benefit of liquidity. So whenever you want, you can redeem back into cash. So within a day or two, you get your redemptions back. So you put your money on, say, day 1, and if you want to sell, you sell it on the second day and you get redeem your position on the 3rd or 4th day. So that's the liquidity position of mutual fund. Because of the large number of investors involved, you can immediately liquidate your position in the mutual fund if you're in need of money. So that's the liquidity benefit, the second benefit which you can avail by investing in mutual fund. The third benefit which you get is by putting small sums of money, you can get a diversified portfolio. Just imagine if you want to buy a Nifty. A Nifty is composed of about 50 stocks, and the primary stock is Reliance, heavyweight champion, and then you have Hull, you have ITC. All these, if you have to invest, even these 3 companies, if you have to invest, you need a minimum of 6,000 rupees because HUL today is like 2,600 one share. Then you have Reliance 2,600 again another share. Then you have ITC maybe about 500. Totally about roughly between 5,000 to 6,000 minimum you need to invest if you want to avail position in these 3 companies. But however, with just 100 rupees of investment into a mutual fund which actually diversifies into these 3 companies, you can get access to that particular portfolio. So you get a diversified portfolio with a very low investment. So that's a double-edged benefit actually, which I'm calling as a third benefit. The 4th benefit, my friends, you get is the transparency of the mutual fund. So there is a lot of transparency. There is a prospectus document which is shared by the mutual fund. That is this SID, SAI and a KIM document which share the structure of the mutual fund, the regulations followed by the mutual fund, the investment objectives, what are the kind of investment they do, what is the portfolio ratio, what is the asset allocation ratio, whether it's subjected to interest, risk, yes or no, the different risk factors which are involved. All is available in the prospectus document, which is a combination of SID, SAI and KIM document. So you can go through this and it is very transparent, and the investment manager follows the investment objectives set out in this document and uses the capital to follow this investment objective. So that is the 4th benefit, transparency. The 5th benefit which you get is due to the regulations with the investment with the mutual fund has to follow. It is governed by SEBI. They have to follow all the rules and regulations set by Security Exchange Board of India, which is the governing body of all security related activities in India. And for the commodities market, it's a different body. That's the futures. That's the future market that is governed also under SEBI lately, which is coming under SEBI lately now. But nevertheless, there's a regulatory body which governs your investment through mutual funds. So you can be best assured that you are protected from a regulatory standpoint. So that's the fifth benefit. The sixth benefit which you get, my friend, is one of the key benefit which I like the most. That is your tax deferral. Just imagine if you do direct investing in stocks, you get dividend income, and if you want to sell, you have to pay capital gain. Of course, limited up to 1 lakh of capital gain if it is for long term. But the mutual fund body is not liable to pay any taxes on the income which they derive out of these particular shares or securities. So the investor indirectly is deferring all the capital gains and all the income, whatever he might be liable to actually pay taxes, he is deferring to a future unless he sells the units of the mutual fund. But within the body of the mutual fund, whatever the fund manager does is not liable to pay any taxes as a matter of fact. So that's the benefit. You get a tax deferral benefit. And then finally, the seventh benefit, which also I like the most, when I like to combine direct investment approach and mutual fund investment approach by using this seventh benefit, which is your ELSS scheme, equity linked savings schemes, wherein if you invest up to a portion of 1.5 lakhs, you can get double benefit. By investing up to 1.5 lakhs, you get a tax benefit, as well as you get a benefit of a long-term investment lock-in about 3 to 5 years, and then you can get capital appreciation over a period of time. So that you get tax benefit, double dhamaka, you get even a capital appreciation as a matter of fact by investing in mutual funds. So some of the key benefits which I like most about a mutual fund is that the taxes are deferred. Whatever capital gains and income derived from the mutual fund, there is no tax applicability paid by the mutual fund unless the investor himself sells units of the mutual fund. The second benefit which I like the most is the diversified portfolio. By minimum investment, I get access to a well-diversified portfolio. And the third benefit, my friend, is that which I like the most, and you might like other sets of benefits, but the third benefit which I like is that ELSS scheme, when you can get benefit of 1.5 lakhs if you are tagged to the old tax regime, and also get a benefit of capital appreciation over a period of time. So that's with respect to advantages of mutual fund. So now let us get on to see what are the disadvantages of mutual fund investing. Oh, surprising, would there be disadvantages? I mean, there are so many advantages, only 4 disadvantages. But let us see, disadvantages are key and might impact the future returns of the particular portfolio for the investor. So one of the key disadvantages, one of the major disadvantage of mutual fund is the recurring expense cost. Now, irrespective of our investment, whether the investments are huge or minimum, you have to pay the same percentage of expense towards the mutual fund. So that's your expense cost, and then you also have your transaction cost based on the transaction which you have done to invest your capital in the mutual fund. That's a one-time transaction cost which you have to pay because of the particular transaction, depending on the limit of the particular transaction. So please read your prospectus document to understand what are the different kind of fees applicable on the specific scheme of the mutual fund. But these are 2 key type of fees which are loaded by the mutual fund, and then you have another fee which is the third fee, which is your exit load. So whenever you want to exit or redeem your position in mutual fund, you have to pay some portion of fee to the mutual fund because you're exiting out depending on the tenure you have put into the mutual fund. So depending on whether it is 3 years or whether it's 5 years, you are applicable to pay a exit load. However, there is no entry load in India mutual fund, so that's a great reliever, I guess. So, but these are the 3 key expenses which the mutual fund investor will have to bear from his side. And the expense ratio, my friend, year-on-year expense ratio is to the tune of 1.5 to 2.5% in case of equity mutual fund. It could vary in case of debt and money market instruments. So please read the prospectus document very carefully to understand what are the expense ratios borne by the mutual fund body which will impact your returns in the future. So please do a well judicious call when you look into the expense ratio of the mutual fund. So that was the one of the key disadvantage of investing in mutual fund. The second disadvantage of investing in mutual fund is that you don't get a say of what you want to invest into. You're all relying on the fund manager. You can't call up the fund manager and say, hey, invest in this other company. Don't invest in tobacco company, or don't invest into construction company because they are encroaching a lot of properties. So I want to keep away from construction company, or I want to keep away from fuel companies or automobile companies, specific kind of company which you might not want to risk your investment, or you have certain kind of a mindset which you want to keep away from such investment. You cannot do that. But however, there is a scheme called as the portfolio management scheme, which are run by some of the brokerages, and you can avail a portfolio management services when you can define a portfolio for yourself. What are the kind of investments you're looking for? You can define your own investment objective with the brokerage. So that's a separate topic. That's about portfolio management services, which you can still avail a professional management, a professional manager, which is called a financial advisor, or somebody who is financially competent, who does the investments on your behalf. And it has obviously some fees involved as well. But nevertheless, if you're investing to mutual fund, the disadvantage is that you don't get a say about your investments. The third disadvantage is that you have a choice overload. You have so many choices of mutual fund. You have so many choices of schemes within the mutual fund. And then what do the investor should do? He'll get obviously confused. Which scheme should he go for? I was also myself confused, which scheme should I go for? Then there is a set of criteria which is available, obviously, to wherein you can need to go to this criteria and then decide which scheme you want to select for yourself. The fourth disadvantage of investing to mutual fund is that the first disadvantage is key. So there is no other fourth disadvantage. It's just the first disadvantage, which I'm making the fourth disadvantage again, wherein your expense costs, which are the three expenses, which are transaction, your yearly expense cost, as well as your exit costs. These three expenses which you need to incur as an investor, you need to check carefully through the prospectus document and then take a judicious call whether you want to go to the mutual fund route, whether it makes sense with respect to tax implication, with respects to the returns which you might derive in the future based on the expense ratio versus that of a direct investing into stock, wherein you can mimic the portfolio easily. So I hope from this video you have understood what are the advantages and disadvantages of investing in mutual fund, and take a judicious call whether you want to go to mutual fund route or direct investing route. So please approach a financial advisor if you are still confused, and I'm sure the financial advisor is able to guide you whether it is beneficial to go to mutual fund or take a balanced approach of doing some portion of investment into mutual fund as a strategic allocation, 80% of investment to mutual fund, and then 20% of your investment you could do in direct investing in stock to increase your alpha returns, increase and beat the benchmark returns of the mutual fund itself. Isn't that great opportunity for the direct investor? So that's all in this particular video. And if you have any comments to share, please drop in a note in the comment section, and I'll be glad to get back